To bring on board Sandeep Tandon of Quant AMC now. He's the CIO and the CEO there. Sandeep, good morning. Thank you for joining us. 3 months ago, when we spoke to you, you said that the Bank Nifty is going to be the drag on the market, and the Bank Nifty continues to be the drag on the market. Let's start with what is your take on financials? Because even though HDFC Bank, Kotak Mahindra Bank or ICICI Bank, they don't need capital, all of them have indicated, shared and communicated that in next 3 to 6 weeks they would be raising a lot of capital. If banks are not lending and if banks are parking surplus liquidity with Reserve Bank of India, why would they raise tier 1 capital? Because that will only have an impact on their return ratios in the near term.
So I agree with you, but the way banks have shown urgency to buy or increase their capital clearly indicate that something is not right. I don't know what is wrong. From a behavior perspective, we can definitely say they definitely find the environment could be tough. Maybe the new round of NPA cycles coming back, which most of us cannot visualize or see. Maybe banks being internal people have a better sense on it. So that's the way I like to maintain some sort of negative stand on this entire space from a medium-term perspective. See, the key point is that if you really look at when we spoke in the month of March, we talked about market bottoming out. Now we look at what is really happening is a very peculiar situation which is happening globally, where risk appetite, global risk appetite, when you talk about Indian market risk appetite or US market or global market as a whole, has bottomed out in the month of March. It's like nearly 3 decades low, 4 decades low. That sort of risk appetite was lowest point. And very interesting is that in the central bank pumping liquidity indicators or most of the liquidity parameter which we also track is closer to the upper end. Okay, we have seen global liquidity increase by nearly 33% in last 3 months or so, and it is expected to increase further also. So typically market rallies when liquidity is rising and risk appetite is rising. Okay, so in the recent scenario, we have seen the risk appetite also from the extreme bottom started moving up, and risk appetite and liquidity was also supporting. Now, global risk liquidity parameters are peaking out. Okay, it's closer to upper end, and risk appetite is also showing some signs of exhaustion, which means this rally which we have seen in the global market can taper off or consolidate. Global market can consolidate with some amount of negative bias in the near term as our risk aversion indicators are again spiking. So I think it's a background which is slightly cautious. And banks being a part of leverage economy, I like to be more cautious with this background.
So if banks are cautious, which in a sense is the heart of the economy, then why are markets excited that tomorrow will be better than today? You know, banks are the first one who should benefit if the economy turns around. Banks are the first one which will act as a canary in a coal mine, if I may use that phrase, as an indication of where things are moving. So one side markets are worried about banks, second bankers are worried about their own balance sheets, and then markets are saying we don't worry about what bankers are saying, what our outlook on banks is, we like the economy, we like the market because tomorrow will be better than today. Isn't that a conundrum?
I tell you, I think I will link this question with more of a psychology of the people. Okay, if you really look at the bank was the last to participate. Actually, market started rallying from 24th of March. Okay, and only in last 17-18 days, actually, bank has started inching up. So, which clearly means that typically when cycle peaks out, all the weak counters actually start inching up, and so is the case with the banks. And globally, I will look at it's not about Indian market. I think it's a global phenomena, because global market has rallied, particularly US, and that's the mother of all exchanges, which has given a big move. So I think globally people have chased now. The left out feeling is very high. We call it the buying panic, which has been set in these names. So I think that is also peaking out now, given the deteriorating macro which we are looking at, or in terms of our own predictive analytics tools which we try to work out. We believe easy phase of this liquidity is over now. And the difficult phase, we may enter into that phase now. So if you really look at the global market, liquidity obviously has supporting the market, but liquidity also has some side effects. Okay, the whole thesis currently is based on the low inflation. Okay, but with excess liquidity, I expect inflation is coming back with a bang. If not this year, definitely next year. And that is something which need to be worried from a equity market perspective.
Sandeep, is it true that in last 3 months some of your schemes are up 42%? I looked at the data in the morning, but let me ask the CIO and the CEO, how have you done that?
So we have done reasonably well given the market condition which we have seen. We right from January, when we saw risk aversion started rising, we have moved towards low beta names. Okay, and this is one of the reasons, and we started increasing our exposure towards defensive names like FMCG and pharmaceutical stocks, and we pruned down banking significantly and financials in general. And that has really helped us in giving our performance. So our delivery has been pretty decent in terms of we are not able to beat the benchmark indices. We also beaten the Nifty also for most of our equity schemes, which is a good achievement in the current difficult environment.
Right. Sandeep, in terms of valuations as well, let me get a perspective from you on that. It's been an ongoing debate as everyone eyes the rush of liquidity into markets. As you said, if the easy phase is over now, where also do you see us settle when it comes to valuations? Where do you feel they're overpriced? Where is still opportunity according to you?
So for a while, we have been talking about from 2018 until 2023, we are saying that this is a volatility expansion phase. Okay. So when market, we expect the volatility of the most of the asset class, whether we talk about currency market, commodities market, equity, or even the credit market, if the vols remains elevated for a longer term perspective, then strategy has to be very different. So that's the reason we are advocating that we believe in a very dynamic way of managing money rather than saying that traditional tools, because the traditional tools are very effective when the walls are very low and you are in the one way up move. Okay. And the current environment, we expect the choppiness will remain. It's a very peculiar situation, which I was sharing a few minutes back, where liquidity is the lifetime high and the risk appetite is nearly lifetime low. Okay. So it's typically both things go hand in hand if market has to move up. So we are looking at a scenario which are both are extreme end. And in that scenario, I think the sector rotations, stock pickings will play a role, and the rotation has to be relatively quick as compared to what we have seen in the past. So we have to manage in a very dynamic environment. Yes, it's a very challenging environment. So I would like to, that's the reason we are maintaining managing our portfolio from in a dynamic manner, more active manner, and keeping in mind risk aspect also. So we decided to keep relatively low beta portfolio, and that's the reason it gives us lots of safety in the downside, and the sector rotation plays a key role in our performance.
That's really interesting, Sandeep, because we've been hearing a lot about how the recovery is going to oscillate, and we may actually see a reopening, a closing, an opening in terms of even businesses as they struggle to figure out where they stand over the next couple of quarters. Since we are talking macros and global markets as well currently, I also want to understand to what extent you feel we're at risk to any shocks to the system when it comes to the US markets, because there seem to be more factors lined up there for some kind of event upset over the next few months than necessarily domestically.
So from a US perspective, and particularly if I have to talk about the fancy which we have seen in the technology stock and particularly on the NASDAQ, okay. So from the behavior perspective, our greed indicators are actually closer to 2000 levels, okay, which was the peak of NASDAQ, and then we have seen a multi-year correction. Now we have obviously crossed those levels, but in terms of fear and greed perspective, I have to quantify the greed aspect. So we are similar levels, so which clearly gives an indication from a behavior perspective, markets are peaking out. And if I have to look at the larger macro perspective also, given the dollar move, okay, so if you look at the liquidity of its side effect will be we have seen a weakness in the dollar out there. The dollar index has corrected a lot, and I expect that correction can continue from a longer term perspective. I'm not saying this is a linear move which I'm looking at, but from a 1 to 3 years perspective, I expect the dollar index to correct down. And then obviously it has a side effects. So what it leads to, it has some support to the commodities market. It gives some support to the equity market from a near term perspective. But if I have to look at the larger picture in the US market, the macros are deteriorating a lot. Okay, we have never seen this sort of liquidity expansion. If you really look at the global liquidity or the central bank liquidity, which was pumped during the GFC1 phase, okay, in 2000, way back in 2008, this time liquidity is 4 times of that number. Okay, that this magnitude itself give an indication. And the real impact of liquidity actually can be felt after 6 to 9 months, or sometime it will take even 15 months. So if we believe that the liquidity peaks out in down the line few months, okay, because this sort of phenomena cannot last forever, okay. So the day liquidity peaks out, in the lag effect of maybe 6 to 9 months, you will see the impact coming on the market, and then the side effects of the market will be very, very meaningful. And so we expect that even US market is in the final phase of peaking out. It's a question of time, whether it's a 2 weeks time. I definitely expect that this month itself, in the next month, July onwards, I think we have talked about in our book also. So we are slightly cautious, and I will say extremely cautious on US market, given the greed levels which we have seen. And so is the case. We are seeing something similar happening in the penny stocks in India also. Okay, we have seen stocks hitting circuit to circuit. And this is a classic case of euphoria which is happening. So it's not a euphoria which is happening in the large cap or the frontline indices. So if you construct these junk stock index, then definitely you will get a fairly good sense that euphoria is visible. And this is definitely a signs of worry.
Okay. All right, I'm trying to sort of put together some of the various factors that you've described today, Sandeep. It's obviously a constantly changing scenario, and one that's changing at a rapid pace. When you also talked about sector rotation then, let's talk about the here and now, even if you're constantly shifting and churning, but talk to us about the current strategy.
So when I say, we are very macro-centric firm. So if we believe that that risk aversions, our quant risk aversion indicator is again started inching up, which clearly means that we have to tune down further leverage stocks, okay, from the current level. So if I have to look at from the immediate basis, what we are trying to increase some amount of exposure toward the defensive names, particularly on the consumption. One round of consumption peaked out somewhere in the early phase of April. And these stocks corrected a lot from those levels. Maybe we have seen some of the names corrected even 20-30% also. Okay, so we are looking at increasing exposure toward the FMCG space, maintaining our exposure toward pharmaceutical space, and some of the technology names. So it's more of a exposure towards defensive sector than compared to financial space. And utilities, of course.
Just going back to the US markets as well. Fair enough. Just going back to the US markets that you were talking about, do you think that as of now, there is that case that's sort of playing out, that the markets over there are facing that test of reality versus liquidity? And given the run up to the US elections and the kind of stocks that have been moving up as well, and the moves that have been taken by the central bank there, what's the outlook on the kind of risk appetite that you're envisaging in the US? And how have you read into the measures from the US central bank?
So if you look at the combined impact, when I was talking about that even US risk appetite is closer to multi-decades low, okay, and which is accompanied by extraordinary global liquidity, or if I have to call it the bad liquidity actually has moved up. So it's basically bad liquidity, what we call as a central bank liquidity or stimulus liquidity in some form. So globally, the private sector liquidity or the good liquidity is on the lower side, where the bad liquidity has moved up, which is not a good phenomena. And given the background that liquidity remains on elevated level, market cannot fall significantly. Okay, given the background that also we are expecting a choppiness, so we have to live with this volatility phase. Okay, market, because of very low risk appetite indicator, market cannot fall substantially, and liquidity obviously is supporting that, but we remain very cautious. Okay, so I think the best way and it's a difficult phase for a fund manager to look at and play around and how to manage the volatility. Maybe a great time from a trader's perspective. So it's all about how well you can manage this volatile environment, okay, where market will not going to see a very massive correction or a massive rally from the current levels. I think it will be choppy, and one has to live with that because there's a phase which we are looking at from a longer term perspective.
Okay, fair enough. And for our own markets, what is the sense that you're getting in terms of the kind of gush of liquidity that has managed to support our markets so far?
So when you compare global liquidity versus compare developed market liquidity versus emerging market liquidity, is definitely emerging market liquidity is significantly low. In fact, China is actually pruning down the liquidity. They are reducing the liquidity in the system. So it's a very different scenario which you look at from the global perspective. And within emerging market space, I think India has done not much up to that extent as compared to other countries when it comes to the real liquidity impact. Okay, but definitely. We all are impacted by the global sentiments. So from a near-term perspective, I think easy phase, as I said, is largely over. So I think we are getting in second round of COVID patient numbers increasing. And if I'm safe to say, some amount of euphoria which has been witnessed in some of the Indian stocks also. I like to be taken a very cautious approach. I'm not very extremely bearish. I'm not extremely bullish. Okay, but very, very cautious from the current level.
So Sandeep, walk us through your portfolio right now. If you underweight banks, then are you overweight Reliance? What are you exactly overweight on? Where are you investing your clients' money and your unit holders' money?
So we are definitely overweight pharma, we are overweight telecom, we are overweight utilities, and then we are overweight specialty chemicals, agrochemicals, okay, and some of the oil marketing companies. Okay, these are the sectors we have relatively overweight positions.
What is the logic in being overweight on pharma? Because with pharma, some would argue, A, the run-up has happened. B, not every pharma company would benefit. And C, when every company is talking about increasing dependence on the local manufacturing, don't you think that Indian pharma companies could really be on the receiving end? Because if you're making in India and selling it to US, then it's a matter of time. There is going to be a Me America rhetoric which is going to impact Indian pharma exports.
So I agree with you, and that's the reason some of the exposure we have pruned down, which has more linkages with Chinese market, and we have tried to increase exposure toward domestic, some of the pharma companies as well as the specialty company, which are completely backward integrated. That risk is definitely we have, okay, and we cannot deny that part. That's the reason we have pruned down some of the exposure. So we got a good up move right from March, April until the month of May in these names. So we have pruned down some of these where we think risk is relatively on a higher side. So we have pruned down some of the exposure in these names. Not completely, but definitely pruned down.
Would you take a deep dive into commodities or cyclicals? Because that's where the world is divided. Some worry that world will not pick up. Some worry that cyclicals will have their own issues in terms of getting private sector capex. It absolutely amazes me that one side markets are bearish on, one side markets are selectively bullish on economic recovery, but very few are bullish on cyclicals and metals, because if economy is to come back, demand for metals, cement and cyclicals should also come back.
So I agree. I will link this. Definitely demand supply is one aspect, but I'm more linking with the global macro. Okay, if the dollar index, if we believe that our call in dollar index is right from a longer term perspective, then definitely weakness in dollar index will support commodities, whether you talk about bullion. And so we are more optimistic on the bullion as a space. We are equally optimistic on agri as a space. Okay. And when we are talking about that, the side effect of this extraordinary liquidity which in the system will lead to a extraordinary inflation also, so people are not willing to accept at this point in time. And inflation comes back because of supply distortions and even for the fiscal stimulus also. I think it will help commodities. Okay, so if you look at the overall commodity prices are inching up. Okay, the ferrous and non-ferrous has not moved up as compared to what we have seen in the bullion side or the agri side. So net, we are more positive on the space. Definitely, we don't like many stocks in this space. That's a different issue, okay, because we don't have many options to play agri directly. But as a sector or as a house, we are definitely not negative on the commodities.
Sandeep, thanks for joining us this morning. Good speaking with you, understanding your rationale and also some of what you're anticipating in the months to come.